Hey everybody, Smart Silver Stacker here. So the Fed, along with the Treasury and the FDIC, have wasted no time in intervening in these markets. Last night, they announced full coverage for all depositors at Silicon Valley Bank, SVB. That's the second largest bank to fail in US history. And according to the announcement that they made, even those depositors whose accounts exceed the $250,000 FDIC threshold will be made whole today, Monday, March 13th. Now, according to Janet Yellen, the taxpayer is not going to have to foot the bill for this, which I do think is interesting. If the taxpayer doesn't foot the bill, who will? But what exactly this intervention will look like remains somewhat unclear. It is an evolving situation, although the Fed did announce a new lending mechanism to help this troubled banking sector get some liquidity, and this is called the Bank Term Funding Program, or BTFP. And with this new mechanism, banks will be able to get loans from the Federal Reserve, and they can put up US Treasuries, agency debt, and mortgage-backed securities as collateral. Now, specifically, the Treasuries aspect of that is pretty important because for collateral purposes, the Fed will be valuing those treasuries at par value or face value. So all of those banks who have unrealized losses on these long-term bonds that they purchased when yields were much lower, well, now they don't have to worry about that, I guess, even though these bonds are worth considerably less than their face value. The Fed will be loaning the banks cash with the bonds valued at par. So basically, the Fed is going to be taking on all the risk associated with these losses. I mean, I guess the Fed can always just hold them to maturity and not be forced to liquidate them because, they have a printing press. After all, they don't have to worry about liquidity concerns over at the Fed. And of course, these loans sound a lot to me like they're going to have a big inflationary effect since they're going to be replacing these illiquid bonds on the bank's balance sheet, these bonds that they have unrealized losses on, with cash to the extent that the banks take advantage of these loans. Oh yeah, and by the way, gold and silver getting a very nice rally on this announcement. In pre-market trading, the time I'm recording this video, gold is back up to $1,900. Silver is up more than 3% this morning. It's back up over 21 bucks. And today's video is brought to us by SD Bullion, home of the lowest price on gold and silver, period. You can check out sdbullion.com/new to get your first purchase of gold or silver at spot. And oh yeah, by the way, another bank also failed. I haven't even mentioned that yet, but Signature Bank of New York has been shut down. And that marks the third largest bank failure in US history. So think about that. We have the second largest failure and the third largest failure occurring within days of one another. So will this intervention by the Fed and the FDIC and the Treasury be enough? Or are more banks going to fail this week? Well, it looks like First Republic Bank may be the next one on the chopping block. Shares in that bank are down more than 70% in pre-market trading. And who knows, by the time you are watching this, maybe more institutions will have bit the dust. So gold and silver, they are rallying on this systemic risk, which it's what they should do, if you ask me, being hard assets outside of this system, which now seems to be perched on the edge of a cliff. It is reasonable for investors to be moving into these traditional safe havens. And there's a few other things that we can take away from all of these developments over the weekend as well. First, the Fed really wasted no time in trying to get ahead of this crisis. This announcement of intervention, it came last night, just about 15 minutes after futures began to trade. Now, the Fed understands how vulnerable this system really is and how fragile things have become. And that is why it is so important for them to try to get ahead of any financial crisis. They are right that they do need to try to get ahead of these things insofar as the goal is to avoid all economic pain whatsoever. That's the thing about these interventions. They basically avoid the short-term pain. The short-term pain is kind of a feature of the free market solution, which would allow these insolvent entities to fail so that their resources could be distributed more efficiently and their bad debt can be eliminated from the system. But the thing about the free market solution, it involves short-term pain, but it provides long-term economic health. The Fed's approach, what we've been getting for decades now, it eliminates the short-term pain, but it is at the cost of long-term economic stagnation and ultimately collapse. And the problem is that now it seems like we are getting pretty close to that ultimate endgame. And if this contagion continues to spread, the necessary intervention is likely going to be a lot bigger and more aggressive than previous interventions. That is the trend as these things go. They tend to need to get bigger and bigger. And the last one was pretty huge. So if we do see a big intervention, it is going to have to be absolutely colossal to have the desired effect. Now, there's no guarantee that we have hit that point yet. Maybe things aren't as bad as it seems as we wait for markets to open on this Monday morning. But I do think that that point is approaching, even if we're not there yet. And I would not be surprised if the failure of SVB and these other subsequent bank failures, which we are witnessing here in short order, could be the first dominoes in what will ultimately be the mother of all financial crises. As far as interventions go, the Fed has just demonstrated that when push comes to shove, they are going to bail these institutions out. I mean, they really just don't have a choice if they don't want this whole thing to fall apart. All of the papering over of previous crises means that if we get a collapse now, it's going to be very bad. The can has been kicked so far down the road and so many times that now the powers that be, they just really can't face the music and they're going to try to kick it again. The problem with that is at this next intervention or bailout or money printing bonanza, whatever you want to call it, it will be massive and it will be occurring against a backdrop of already elevated inflation, which does set it apart in a very important way from previous bailouts. So for now, the big question, I suppose, is how far will this contagion spread? It's certainly going to be an interesting week. We're just getting started and we may be on the verge of the next major financial crisis. The cracks are starting to show in the system, and the response from the powers that be may very well be to sacrifice the purchasing power of the dollar to maintain the current system and to prevent a collapse. That is the hard decision that they are going to be facing. Now, the president, I haven't read too much about this, but I did see a headline that he's announced there's going to be consequences for those responsible for this crisis. I can only imagine what that might mean. What's he going to do? Round up Jerome Powell and Janet Yellen? Because they seem like the best candidates for who is responsible for this. But I'm sure that's not what he meant. There's probably going to be a lot more scapegoating as this crisis plays out. And one thing that I think we really need to watch out for here, this is something that we're not hearing any word of in the mainstream media, but that is the international response to this crisis if it gets out of hand. Now, I've talked at length on this channel about the growing trend of de-dollarization and the fifth generation economic warfare that is playing out across the globe, and how hostile players like the Chinese, for example, they've been waiting for a time of maximum advantage to make their move against the dollar. Who knows what that'll be? Perhaps they'll reveal the true extent of their gold holdings, or they could initiate a coordinated dump of US Treasuries. And what better time for them to make that move than when the US banking system is experiencing a crisis? Now, this is all just speculation on my part, of course, but as we edge closer to World War III, and we are continuing to edge closer to a global conflict, I think these are also factors that we need to consider in terms of just how bad this crisis could get. Now, markets and investors do seem to be waking up. They seem to have the right idea, bidding up the precious metals, buying gold and silver. And in this type of a scenario, personally, I would only want physical metal, not paper contracts or ETFs. Getting physical assets outside of this house of cards system is the way to go, in my personal opinion. And, if you've been watching this channel, you've probably been doing that for a while. I've been doing it for a while. And when you start to see some panic in the financial sector and things fall apart, I do think it is vindicating for those of us who have been making the transition to hard assets. I mean, I personally am not losing any sleep about the potential failure of the US banking system, except insofar as the fact that it's just going to make life in general very difficult. I mean, I'm not out here cheerleading for this stuff. I would prefer to live in a healthy economy that functions properly and adheres to free market principles and creates prosperity for everybody. But that doesn't seem to be the type of system that we're operating in. So I just think it's wise to stack some silver and some gold at this point. Now, another data point that is coming up tomorrow will be the February CPI data. Now, the expectation is for a 0.4% increase in the CPI month over month, and the year over year number is expected to be 6%. I'm not even going to venture a guess as to what we might actually get in the CPI report, but it is certainly a wild card which has the potential to roil these markets even further. And as we witnessed on Friday with the better than expected jobs report which came out, the non-farm payroll, that coincided with a rally in the precious metals. So it's possible that the whole bad news is good news is bad news paradigm has ended due to this situation in the banking sector. And maybe we'll get a confirmation of that tomorrow if, let's say, we get a hotter than expected CPI print and gold and silver continue to rally. That would certainly be an interesting development. Now, again, this is all just speculation. Who knows how this week is going to play out? There's a lot of moving parts. There's a lot of risk here. But I think one thing's for sure, and that is that in this massively over-leveraged economy, even if this isn't the big crisis, if the Fed keeps up the rate hikes, we will be getting one probably sooner rather than later. Now, as far as Fed rate hikes go, if we take a look at the CME Fed Watch tool, you can see now that the odds of a 50 basis point rate hike at the March FOMC meeting have declined significantly. And some institutions like Goldman Sachs, they're now saying that the Fed may pause their rate hikes entirely at this March meeting. So that is certainly also something we want to keep our eye on moving forward. And, I really do think that one of the most important takeaways from this whole situation is this response that we've gotten from the Fed and the Treasury. I think they've kind of tipped their hand now. We know how they're going to react in the event of a crisis. If things start to fall apart, they're going to print. They'll print as much as they have to. They'll pivot as hard as they have to once something does break and they have the excuse to do so. I mean, I have almost no doubt of this any longer. So inflation, moving ahead, I went grocery shopping yesterday. It's crazy how expensive things have gotten, but that situation is probably going to get a lot worse. The banks look like they may be at risk of failure. So get prepared, folks. It's not financial advice, but you might want to consider getting some cash on hand out of the banks and also getting into some real money, some physical gold and silver, the kind of money that can't be printed or destroyed with a few keystrokes by some faraway central banker. So let me know what you think about these developments down in the comments, everybody. Thank you so much for watching. Stay safe and happy stacking, everyone. Smart Silver Stacker out.